Jeff Spolstra, and this is Mortgage Points. Today, I'm going to talk about a type of a loan you've probably heard about, a lot of people ask about, and so let's talk about it. And that is a Federal Housing Administration, or more commonly known as FHA kind of a loan. It's a 30-year fixed rate kind of a mortgage, just like any other mortgage, but it is a little special. Most people think of it in the context of a first-time home buyer, and indeed, it is a good first-time home buyer loans. The interest rates are often less than a standard conventional loan, and you can get a little lower of a down payment. So with a FHA loan, you're looking at a down payment possibly as low as 3.5%. A typical minimum on what's called a conventional loan, which is a non-FHA type of a loan, is 5% as a minimum. Although you can go to 3% if your income qualifies for it, but it's typically 5%. So on just a typical normal FHA type loan, you're looking at a possibility of a 3.5% down payment. Wish it was mortgage payment. Anyway, what it's good for? It's good for buyers that may have a lower credit score that prevents them from qualifying for a conventional mortgage. Typically, you're looking at maybe around 580 as a minimum credit score for a conventional mortgage. FHA, we can probably go down to 500, maybe a little less. It depends on circumstances. So if your credit's really poor, you might be better fit for an FHA type of a loan. And with a 3.5% down payment, you're looking at less of a upfront investment. Now, a couple important differences. What makes FHA special? Well, FHA loan is insured by the federal government. So you're probably familiar with mortgage insurance, which is what you're going to have added to your loan amount, or your monthly payment, I should say, when you're dealing with a conventional non-FHA mortgage, if you're putting less than 20% down payment. That's private mortgage insurance, comes from private companies, that are not associated with your mortgage lender. FHA, the government is that insurer. They provide the mortgage insurance, and it's a little more expensive. It's kind of split two ways. First, there's an upfront mortgage insurance payment that's due as part of your closing costs. That's typically 1.75% of your loan amount. So it's kind of like paying points. It's just you're paying an upfront amount for the mortgage insurance. And then there's also a monthly component, which is going to vary depending on what your down payment is, what your credit score is, what your loan amount is, all these kind of factors. But it can be probably on average about 0.7%. So you're going to pay two ways. There's going to be an upfront payment, which can be rolled into your loan amount, so it doesn't have to come out of your pocket. But what is going to come out of your pocket is the monthly mortgage insurance on a monthly basis. Now, if you're doing less than a 10% down payment, that mortgage insurance is going to be on your loan permanently. For as long as you have that loan, you're going to be paying the mortgage insurance. The only way you would be able to get rid of it is to refinance it into a loan that doesn't require it. If you're doing more than 10% down, you're still going to pay mortgage insurance. You can put 40% down if you want. You're still going to pay mortgage insurance with an FHA mortgage, but you'll only pay it for 11 years. It's going to automatically terminate at 11 years. So the mortgage insurance can be a little more expensive than conventional, which is why maybe if you are in a situation of having too low of a credit score and not enough assets, then maybe FHA is the better choice for you, as long as you can support the monthly payment. So one other thing is there is a requirement with FHA mortgages. They have a bit of a different appraisal structure. It takes a different kind of an appraisal for an FHA mortgage, and there is a requirement is in that you as a buyer cannot waive your right to terminate the deal because of the appraisal. You can choose to do so if you wish. However, you cannot sign a purchase agreement saying that you give up that right. Doesn't mean you have to exercise it, but you cannot give it up. That means you cannot go into a purchase fully non-contingent. You must at least have the appraisal contingency. Okay, so there used to be some stigma on a seller's perspective with FHA mortgages because the sellers had to kick in a certain funding for some things. That's gone away. So there's really no disadvantage to a seller for you coming in with an FHA loan, other than you can't waive that appraisal right, appraisal contingency right. Okay, so that's FHA loans in a nutshell. If you would like more details, be sure to contact me. I'd be happy to go over them with you and see if you're best qualified for an FHA loan or for a conventional loan. Again, I'm Jeff Spolstra with Summit Mortgage, and this has been Mortgage Points.